Hey accounting scholars, welcome back. We are at the end of the chapter. We're on section 5 and we're ready to put a cap on this baby. Alright, so in the revenue part of the process, right, we sell stuff, but at times we're going to have people that are going to stiff us, right? And these are called uncollectible accounts. So why is it necessary to estimate uncollectible accounts? Well, there are a couple reasons, right? It's first of all, it's in an overview sense, the cost of giving credit or allowing charge accounts is usually estimated as a percentage of sales. It's a cost of doing business. So since it's a cost of doing business, we need to properly match revenue and expense. We've got to match the cost or expense of allowing credit or charge accounts, and we've got to match that to the revenue associated with it. From those particular credit sales or charge accounts. And we want to make sure this occurs in the same accounting period. If we don't have proper matching of expense and revenue, we have statements that are basically invalid. The second is asset definition. If we believe that not all the accounts receivable or the accounts that we've extended credit to are going to be collectible, they're really not assets, right? If they have no future value, they're not assets. And to include them on the balance sheet as an asset would be fraud. And, as we've talked about, that's how some companies get into trouble. So one of the things you want to be cognizant of is, why don't we just simply estimate the amount of uncollectible accounts and subtract it from sales and accounts receivable and call it a day? After all, we can't collect it and it's not a sale or an asset, right? If you think about that question, there's two problems associated with that particular logic. And you want to make sure you get this in your notes. First, a sale was made and you performed the fulfillment of the sale with the expectation of receiving your money in the future, right? So it should be something that is tracked. And secondly, you need to keep an uncollectible accounts, the information on uncollectible accounts, separate so that management can evaluate the credit policies. If you're going to extend credit to people, you have to have some rules, and if the rules aren't correct because you're getting a high level of uncollectible accounts, you need to change those. Otherwise, that's going to affect your margins and ultimately your income and ultimately the success of your business. Okay, moving on. We've talked about revenue process activities. How are these communicated to users of accounting information? Well, the first way it's communicated is the income statement. This base income statement pretty much consolidates what's going on. It shows net sales, uncollectible account expense, and that's usually part of selling and administrative expense on the income statement. And last but not least, the cost of goods sold, right? So you have that information contained on the income statement as it relates to the revenue process. Then combined with that is the balance sheet, which basically shows the net values of accounts receivable. The net realizable value, meaning that you have pulled out all uncollectible accounts. And then last but not least, what you're very familiar with, is the statement of cash flows. That basically shows what cash has been received from the customers as that relates to the revenue process. Okay, some other things that we need to be talking about here are the sales price variance information and the sales quantity variance information. And the question is, how does that relate to the cash received from customers? Well, if you estimate the cash received from customers, the basic strategy is pretty much, or logic is pretty much the same as we've seen before. In fact, in our coffee business, we actually did a schedule of accounts receivable, and we used this math to follow the logic on those particular schedules. You would have a beginning balance of accounts receivable. You would add net sales on account, and that would come from the income statement, and that would give you the maximum amount owed by customers. Now, when customers pay those particular things off, you get cash received from customers, which is a calculated number. You have write-offs, as we talked about, on collectible accounts, and then you have your ending accounts receivable balance. Let's take an example of this. Let's say Allen Company began the year with $28,000 in its accounts receivable account. At the end of the year, this balance was $30,000. Now, during the year, they had some activity. They had to do a write-off of $5,000. But on the good news side, they had sales on account, or credits, sales or accounts receivable, $400,000. And they had to give some sales discounts to get that of $4,000. But the good news was there was no sales returns and allowance. So how much cash was collected from customers? So, I mean, if you basically do the math here, or through a T account, you basically would you'd have your beginning balance of your accounts receivable account of $28,000. You would also then be debiting that side of accounts receivable, which is the $400,000 of new sales. You have a $5,000 write-off of an uncollectible account. And then you have discounts associated with the $400,000 sales, which you credit. You got some cash in, which is good, $389,000, and so you credit that, and then your ending balance of your accounts receivable in the accounts receivable account is $30,000. Okay, let's get back to revenue variances. As we talked about, there are two kinds of revenue variances. Those two kinds are a sales price variance and a sales quantity variance. Sales price variance is caused by the difference in revenue due to a change in selling price. The sales quantity variance is a difference in revenue due to a change in quantity. And these things can be less than planned, or can be more than planned. You could have a higher selling price, or you could have a lower selling price, and similarly you could sell more or sell less. So what's the math associated with this? Let's take an example. County Oak Tables plan to sell 12,000 tables during the year at $150 per table. During the period, it actually sold 12,500 tables. Good news. And the other piece of good news is they sold them at $160 per table versus their plan of $150. So we're going to use the variances here to explain the difference between budgeted and actual sales. And here again, it's math, right? You're basically taking the 12,000 units times 150, which equals $1.8 million. That's basically what was planned, but now we account for the variance, right? We on the sales price, we actually sold items at 160 versus 150, so that's a net plus of $125,000. Similarly, we sold more, right? We sold 12,500 versus a plan of 12 times the 150, and we have $75,000 there, which basically says, hey, we actually sold $2 million. And if we do the math, 12,000 times 500 times 160, that's consistent with our analysis. So that is the good news, guys. We're ending the chapter here. Good job, and have a great night.